The most popular pension funds and wealth managers are destroying your retirement and your plans to retire early, and they're destroying your pension. Let's break it down. Whilst you might not be able to read everything that's on the screen, I'm going to read it to you. And we're going to go through St. James's Place and their various funds. This is just one example of what's out there and how it's damaging you. So let's start off with the St. James's Place corporate bond. Okay. Now, why does it tend to lag the market, or at least its own benchmark? First of all, it's an active multi-manager. That means it's layering manager upon manager. Okay, which I know is not a pretty picture, but it means there's funds investing in other funds. And that adds a lot of cost to what is, in any event, a low return asset class. It's a corporate bond, low return asset class. I'm reading the information that I'm showing you on screen. In rising rate or even choppy rate environments, which are a lot of the time, basically you can be caught out by holding the corporate bonds and the funds there. The problem that they have beyond all of that, fees and interest rates, is they're also designed for income and capital stability, not compounding. So they're not actually there for long run real growth. Let me go through some of the others. Let's take the St. James's Place Global High Yield Bond. Sounds great. Global High Yield. Sounds great, doesn't it? Let me tell you why it's going to cause your pension problems. Higher default risk, because remember, higher yield, junk bonds are high yield, and the drawdowns are a real problem on this, because you don't have the equity-like upside. Microsoft can drop, but it's also got a lot of the upside. With these, you get the downside, but not the upside. So when you actually look at their performance historically, you so often find that actually you're getting the downside volatility, you're just not getting any of the upside. And you'll be told, don't worry, just keep holding them, they'll eventually give you a return. So anyway, they're not the most efficient, let's put it that way, risk for the returns you're looking for. Let's turn to St. James's Place Emerging Markets Equities. And by the way, this isn't just a pop at St. James's Place. That's too easy to do. It's with all funds of this nature to show you the point that I'm making applies across wealth managers when they're picking from a very narrow, cozy group. You think you're diversified. You're actually diversified. Okay? Now, St. James's Place Emerging Market Equities. What's the problem here? The problem here is emerging market volatility. Okay, so you're not going to get peace of mind if you've got peace of mind as a requirement. It's also far better to own emerging markets inside a much wider group of stocks. And by that, I don't mean having an emerging market fund. I mean looking at all eligible global stocks, and you might happen to have an emerging market company within that, not a whole fund and capital allocated to it, where that fund is only picked from emerging markets alone, because then it's going to be very volatile. Okay, let's go with St. James's Place Asia Pacific now and its problems, similar to emerging markets. So here you've actually doubled up, because Asia Pacific, emerging markets anyway. High cyclicality, what does that mean? You get those markets ups and down movements a lot more often. Of course, there's policy risk. A lot of those economies, they really do go crazy on some of their policy changes when they change presidents. At least in the West, we often have independent central banks. With these countries, you've got an added policy risk as well. Again, far better to capture exposure to that region by looking at your portfolio as a whole, maybe a Warren Buffett approach, in other words, rather than saying, oh, one pocket will go exclusively to that region. Let's look at St. James's Place North America and why, again, St. James's Place clients were annoyed. Why isn't it great for growth? And you might think, well, surely North America is. Well, actually, no, because if you look at, say, the S&P 500, it's weighted by the size of companies. It's actually moved by about 7 companies. So it's actually a portfolio of 7 companies. If you don't happen to have those, what I call my quality 5, plus throw in an NVIDIA in there, if you don't actually happen to have them, then it's very difficult to have outperformed even the S&P 500, which is why I talk about my quality 5 every single week, actually twice a week, for the last, 6-7 years of my videos. So simply having a St. James's Place North American doesn't give you access to what actually has been driving the market. In fact, it's more a spray and pray approach. Okay, fine, Alpesh. Let's go with St. James's Place global equity or international equity and throw in a bit of global growth and global quality. So there you've got a few funds, 1, 2, 3, 4, surely diversified, all global in the title. Now here's another problem. You've got overlap. What's also happened is there are variations on the same global equity theme, but just with slightly different tilts, core, growth, quality. So again, that overlap problem means diversification. You've got a lot of companies in there with small amounts of money in each. So you're just paying more in fees, really, ultimately. And of course, multiple active layers add to those fees because at the top, one of those funds is buying into other funds. Okay. And yes, you guessed it. The top fund is paying into other St. James's Place funds. They get 2 dips into your money. Also, by looking at, say, valuation funds and then growth funds, you've got cycle problems. Value works well sometimes, growth works well sometimes. And you might think, well, surely they're timing that. Maybe I've diversified by having both. Actually, not so. You're far better off saying, well, why can't I just pick companies which are undervalued and growing at the same time? Well, they could only sell you 1 fund then and not 2 if they ever did that. So it means you're getting hurt and getting the worst of both worlds because you're missing both. It's like being caught between 2 stools, as it were. Duplication, major problem there. You're paying several times for the same market exposure. And another way I've put it, style boxes can miss the true outliers that drive long-term compounding. Okay, if you look at the portfolios of, say, a Warren Buffett or a Bill Gates, there's concentration in quality companies, which are the ones driving the market, not let's put tiny bits into companies which aren't driving the market, which is what's happening there. Now let's look at St. James's Place worldwide income. Okay, well, income mandates avoid non-dividend growth leaders. Now, what that means is you're really looking for slower, mature companies. These tend to underperform the more innovative companies which have growth behind them. You're basically prioritizing yield or income in exchange for what could be return tomorrow. So that's not going to help you longer term. Okay, so you look at today's figures, oh, this looks good. Longer term, you're not actually growing. It's like getting a high interest bank account today, but actually over the long term, it's not going to grow at the rate you could have grown. So there's an opportunity cost associated with it as well. Anyway, these are just some of them. I've got a bunch more, which I could cover. There's a whole bunch of LNG ones, UK equity ones, sustainable, responsible equity ones. Oh my God. Anyway, I'll do more videos. Do like and follow for more if you've enjoyed listening to this, and hopefully you found it informative and not too scary. Look at the links in the bio. If you'd like a free educational pension review, have a look at the link in the bio, alpeshpatel.com/links. That's alpeshpatel.com/links, and I look forward to hearing from you.